Don't start your Memorial Day weekend till you've gotten your daily dose of the money life.
I still think there's some headwinds that are potentially looming out there, and that might limit the upside. One being the move that we're seeing in the bond market, but we also are seeing, I think, the economy slowing, especially on the labor market side, and that still might take a little bit more time to work its way through into the real data. And I think once we do start to see that marginal slowing, we might actually get a growth scare at that point. And that's why I think we might have a little bit of a capped upside from here going forward.
That's Jack Janasiewicz, Senior Vice President and Portfolio Strategist at Natixis Investment Managers. And he thinks the market is range-bound, a little more towards the top of the range than the bottom, but he's got a compelling take on the market in today's big interview. But up first, Brian Griggs, Head of Portfolio Strategy and Solutions at Nuveen, will talk about Insights. That's insights, but starting with an N. It's their proprietary way of looking at how small portfolio changes make big impacts in your savings and investing futures. It's a perfect way to look at how the moves you might be considering will affect your portfolio long term. And speaking of moves, we revisit my recent answer to a listener's question about what moves they might make if they need to raise some cash and how they decide what they're going to sell.
To start, press any key. Where's the any key?
Don't press any buttons because you've pressed all the right ones to be here and to live the money life with us. This is Money Life for May the 23rd. Thank you so much for joining me. My name is Chuck Jaffe. I'm your host here, and this show is Independent Personal Finance Talk. And it's not entirely the show we had planned for you because, well, yesterday was a day. Yeah. I wish that was the way the water had been flowing yesterday because that was distinctly not it. Nope, it was not. Been raining buckets. And yesterday, by the way, I needed to be making beef jerky because we had prepped it all and you need to make it at some point or otherwise you're going to have problems and I don't want to let it go to waste. So I was making jerky in the rain. It was affecting my smoker. But the bigger side was that in the evening, there was some flooding. And I wish it wasn't just those drips. It wasn't quite that bad, but it's something that I have to deal with. I'll be dealing with it presumably all day today, potentially through the weekend and more. And, my computer, the weather app is saying, hey, there's a flood warning in effect. Yeah, in my house. Thanks so much, guys. Yeah, it's the second time this has happened in about 18 months. Hate it. We've done everything to make it that all the damages, et cetera, are as minimal as possible, but that doesn't mean there's nothing that's happening. And so that's part of what we're going to be dealing with today around here. For you, what it means is that I had to not take the time to answer a fresh question, which I was about to do. I had a really good one picked out. I'll save that. We'll answer that in the next week or two, but we're going to go back to the question because I still think there's a lot there. And as I was trying to figure out what we could do, I didn't want to bring back interviews because while you should be listening to this show as often as you can, please, we think that's the best way to do it. Obviously, we understand it's a lot to ask of you. The flip side of it is that you need to be aware of time elements. And I'm a little reluctant to rerun an interview where you might hear something and things have changed because things have been changing so quickly. It's like we said, we didn't air the interview with Jordan Rizzuto this week because he was talking about where their indicator was. And by the time we were ready to air it, the indicator had changed. That's a little tricky. But the answer to the question on if you need to raise money and you've got to think about selling right now, and I have been asked it, not only the one on the show, but I had it just the other day from somebody in my life who's going, hey, I need to pull some money or start thinking about pulling some money and I want to do it. I've got a ways to go. He's talking about how he's got to do it for a wedding. Okay, great. He's got to do it for a wedding. And the wedding is not today or tomorrow because then he would have been way too late and would have less choices. But he's starting to think about, wait, if I've got to pull together some more cash to pay for this, how do I want to do it? And he was asking, is there a process? So again, that's what we're going to deal with. Brian Griggs, really interesting take with him. And Jack Janasiewicz is always a great guest. So we've got great stuff for you. We're going to get straight to it. Remember, you can reach me at chuck@moneylifeshow.com. I would love to hear from you. We won't have a show for you on Memorial Day, which I know is of no surprise to anybody, but we will be here the rest of next week. And you want to be here with us, and we'll talk more about that at the end of the show. So let's roll it out. The Navigator with Brian Griggs kicks us off in a moment.
Dig deep into business development companies at the Active Investment Company Alliance 2025 BDC Forum. It's Wednesday, June 11th in New York City. A full day of big names in BDCs at the podium or on informative panels and networking opportunities with fund sponsors, asset managers, institutional investors, and others who are actively involved in business development companies. Advisors can get 7 CE credits for attending. Go to aicalliance.org/events for the full schedule and details. Use the code NAVIGATOR20 for a 20% discount on your registration fee.
Brian Griggs, head of portfolio strategy and solutions at Nuveen, is here. We're talking about the impact of potential portfolio moves you're considering now. This is The Navigator. Welcome to The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization that represents the full spectrum of the closed-end fund business, from investors and users to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. And today, we're looking at asset allocation decisions and the impact of potential portfolio moves with Brian Griggs, who's head of portfolio strategy and solutions at Nuveen. And we're discussing Insights. Think insights, but drop the I, so you start with the N of Nuveen. Insights is the firm's proprietary analytical service that digs into portfolios to see how changing allocations shift risk and return outlooks. You can learn more at nuveen.com. And if you want to learn more about closed-end funds, interval funds, and business development companies generally, check out aicalliance.org, the website for the Active Investment Company Alliance. Brian Griggs, welcome to The Navigator.
Thanks, Chuck. It's great to be on.
We are living through times that have people who do big, broad forecasts changing their outlooks, talking about potential for recession being up and what people should be doing given tariff outlooks and all these other sorts of things. And of course, there are people who say, just sit still. But when sit still is hard to do, well, the flip side of that is people want to make moves. So help us understand, if you're making little moves based on news and what's happening, et cetera, how much of a broad impact should you be afraid, like that you make a little move and it becomes much bigger for your portfolio? Because I know people who are worried about doing too much, but I also know people who do a little and don't necessarily understand how big it could be.
Well, Chuck, it goes without saying, but we always say in our group, there's no crystal ball, right? We're not here to time the market or come up with some provocative statement about how the market is going to transpire over the next 3 to 6 months necessarily. We're really thinking longer term. How do we build well-diversified portfolios for clients that really can weather the storm ahead and put their end client or the end beneficiary of those assets in the best probability to meet their long-term financial goals? And we do that a few different ways. I think what really helps Insights stand apart and what our team provides for Nuveen's clients is threefold. One, we always say there's a reason that the windshield is bigger than the rearview mirror, meaning that it's important to have tools that can help you evaluate forward-looking assumptions for returns and risk when building portfolios. Two, our platform is built to really not just help you allocate across public markets, but also incorporate private markets into your diversified allocation to help kind of build a smoother ride in terms of risk-adjusted returns from portfolios. And lastly, I would say we're embedded in the Nuveen investment organization. So our team of strategists is meeting with our CIO, our head of fixed income, our head of real estate on a weekly basis, and kind of getting that color from our PMs across the firm. And we're incorporating that perspective into the 100 or so portfolio reviews that we do a month for investment advisors and wealth advisors alike.
I'm curious, you do these evaluations on an ongoing basis. You're working with advisors, digging in and running various cases, representing, by the way, billions of dollars that's actually been invested. And so if allocations are changing, where are they heading to, or where should they be heading to? Because the expectation is that our money's flowing in the right places, but we know from at least how individual investors work that they have a tendency to go to the wrong places at the wrong times.
That's right. I would say we've been doing this close to a decade now. And one overarching theme, even when we started the Insights program, that we noticed in portfolios is perhaps too much exposure to US large cap stocks on the equity side of the portfolio. And on the fixed income side of the portfolio, too much of a reliance on interest rate sensitivity or duration in fixed income allocations. Being able to address those two pain points today is even more important given all the volatility that we're seeing, macro uncertainty when just looking out over the next 6 to 12 months or so. Overall, the three big trends that we're seeing in portfolio allocations are the three pain points that advisors come to us with. Start first on the equity side of the portfolio. So, of course, we had back-to-back years in 2023 and 2024 of 20+% gains on the S&P 500. That resulted in some equity allocations that were very heavily tilted towards U.S. large cap equities, particularly the growth side of the portfolio. So one theme that we've really been approaching with those advisors is looking for opportunities to diversify the equity side of the portfolio into higher quality companies, such as dividend growers, infrastructure stocks, international equities, which particularly today look attractive on a relative valuation basis. And for the first time in a while, have some interesting earnings growth trajectories that we think should benefit them in the years ahead. The second main theme that I think a lot of advisors and their clients are wrestling with is a lot of cash on the sidelines. By some estimates, if you look at money market funds, household deposits, we estimate the total cash pile out there today from high net worth investors is something close to $11 trillion, which is about 38% compared to the US GDP. That's high not just compared to history, but it's also high compared to some notable risk-off periods throughout history, such as the global financial crisis and the depths of COVID. Today in fixed income, you don't have to be a hero on the rate side of things to generate an attractive yield, meaning you don't have to take on a whole lot of rate risk to generate attractive forward-looking risk-adjusted returns, particularly for those high-tax individuals. I think today the opportunities in the municipal market are about as attractive as any point in my career. If you look at starting yields in municipals today, they're in about their 97th percentile over the last 10 years, and spreads are also fairly wide. So I think it's a good opportunity for those that have been sitting in money market funds to reorient their fixed income allocation, take advantage of some of these yield opportunities that are out there right now. The third theme is the move into private markets. Now, not only is private markets kind of been more front and center for investment advisors over the last few years as more firms have come to market with products, but clients are asking about them because over the last 5 to 10 years, clients generally have gotten much more wealthy. Wealthier clients tend to have less of a need for a large portion of their portfolio to be in daily liquid investments. I think on top of that, a lot of clients are looking at the equity market volatility. They're looking at starting equity valuations today that are north of 22 times earnings, and they're asking the question, how can I get that 7 to 10% return with part of my portfolio, which is more or less what the S&P 500 has done over the last 100 years, in a way that exposes me to less daily mark-to-market volatility? So we're having a lot of conversations, reorienting portfolios, taking advantage of some of the more income-oriented private market asset classes so they can help lower the volatility of the overall portfolio and also diversify what they're doing within traditional stocks and bonds.
Is the goal for most people to be reaching a certain level of profits? Is it to be consistent, or is it to protect against the downside? Because it doesn't sound like much of this is about stretching for yield, though it may be about improving an overall performance of a portfolio.
I think it's that holistic overall portfolio view. That's really what we've seen change in advisor behavior over the last 10, 20 years. There's a point in the investment landscape where I think a lot of investors, allocators, advisors looked at their portfolio as a list of line items. How are these different managers performing? Who are my top performers? Who are my bottom performers? That's changing. A lot of allocators now are looking at portfolios more like a large institution, where they realize that the sum of the parts is really what is going to move the needle for their clients. So to answer your question, I think the move into private markets, it's really more about building in that diversification with less downside risk potentially than the public equity market, but still being able to generate all in a portfolio return that can outpace inflation and taxes over the long run. That's really what's driving that change of behavior and why we're seeing more advisors come to us for help with their private market allocations. With that said, Chuck, it's not as simple as your standard Markowitz exercise. We're just looking to kind of goose the risk adjusted return. These private strategies, they are more complex, so they need help evaluating the risk of these different strategies, and more importantly, articulating the end benefit to their clients so that their clients understand the game plan and they're more apt to stick with it when times are more volatile in markets.
Private credit has been a subject that has drawn a tremendous amount of interest. And as you point out, people have exposure, but maybe not enough. But I'm curious, in all of everything else that is going on, is there one particular asset class or maybe one or two asset classes? They don't have to be something totally different, but that you think people are overlooking? Like, is there a place where, on the way out the door, you just kind of wave and go, hey, don't forget about X?
Yeah, absolutely. Now, private credit, it's a broad term. There's a lot of different types of private credit out there. We think in particular right now, middle market direct lending, so loans to private equity backed companies where you can generate high single digit returns. That's an area of the market that has not only outperformed most fixed income over the last 3 to 5 years, in some cases, it's even outperformed private equity, depending on the strategy. So we do think we're in the early innings there. But some other ideas that sometimes get overlooked, for those high tax clients, looking at things like high yield municipals in a interval fund wrapper, right, where you can get exposure to high yield municipal bonds that are perhaps less liquid. That is an interesting area right now where you can get very attractive tax equivalent yields if you're in the top tax bracket. So I guess that kind of also fits into the private credit discussion, but perhaps not how many firms are out there talking about private credit. I also think the one area of the private market universe that has really been marked down over the last 3 years and is poised for a comeback is commercial real estate. Now, hear me out, because I think a lot of people hear real estate and think, well, big downtown offices, work from home, work remote, that's not an area I want to be right now. I would agree with you, and Nuveen would agree as well. But there's a lot of different types of real estate out there. And here are some interesting stats just to kind of highlight the opportunity. Real estate is all about supply and demand fundamentals. If you look back over the last 10 years at construction starts for commercial properties, apartment starts today are back to 2011 levels, industrial starts back to 2013 levels. It's been a very tough environment for new development, given higher financing costs, higher construction costs, what have you. And I don't think that's going to change in the near term. But the good news is if there's less supply coming online, that sets up a nice dynamic for existing cash flow core properties. And that's really where we think investors should be looking to build in diversification in their portfolios with real estate, looking at areas like industrial, medical office, some of those areas that might be overlooked when people just think of broad real estate. And we think that's one potential area that could be the comeback kid for this year when it comes to private markets.
Brian, great stuff. Thanks for joining me on The Navigator to talk about it. I look forward to doing this with you again down the line.
Thank you, Chuck. Likewise.
That's Brian Griggs. He's head of portfolio strategy and solutions at Nuveen. Learn more about him, the firm, and Insights, the analytical service they developed that's been the basis for this discussion, at nuveen.com. Later on Money Life, Jack Janasiewicz, Senior Vice President and Portfolio Manager at Natixis Investment Managers Solutions, joins me for the big interview. But next, we revisit an answer I had to a listener's question about what to sell if you got to do it right now to raise some cash. That's coming up on Money Life.
Anybody have any questions?
I have a question.
Oh, you can ask questions.
I'd like to ask you some questions.
That's okay. Remember, there are no stupid questions, just stupid people.
Well, Money Life listeners do not have stupid questions, and they are not stupid people. We love it when you get a chance to ask me questions on all subjects financial.
I'm sorry, but all questions must be submitted in writing.
You do have to submit the questions in writing. Chuck at moneylifeshow.com is how you do it, but I'd love to hear from you. Today's question comes from Ted in Sawyer, Michigan. And obviously I went to college in Michigan. Sawyer, I think that's on the West Coast, not too far from the Indiana border, but I could be wrong about that. Under any circumstances, and Ted straightened me out. Ted writes, "Hi, Chuck. I've listened to your show for about a year now. I haven't written before, but I appreciate your perspective. We are close in age." I think that means he and I, and not him and maybe his wife. "And it seems like we are seeing some similar circumstances. So I wanted your advice on something that's happening in my life where it sounds like it's happening in yours too. You mentioned recently that you and your wife have some expenses that are higher than you prepared for. For me, it's that I need to replace my car and my wife's at the same time. I won't bore you with the story, so let's just say that my old car is dying and my wife needs an upgrade to deal with some health changes, and so I need to spend more money than I have in cash on hand. No way I am taking out a loan. I could afford one, but I hate owing people money. I have more than enough money to afford the car. Mine was planned for anyway. But to come up with the cash, I'm going to have to sell something. That's where you come in. How do I decide what to liquidate? Do I sell something with a loss? Do I sell something or a few things that add up to the amount of money I need? Do I take it from a Roth IRA so I don't pay taxes? Do I take it from stocks, with stocks being down so much after the tariffs were announced? Or do I take it from bonds and fixed income funds so I don't have a big loss, even though I more and more like getting the income from the bonds and I don't think I have enough of that? If you have to sell something, how are you going to decide? And again, that's from Ted in Sawyer, Michigan. It's a great question, Ted, and it is one that I think is facing a number of audience members. And yes, it's facing me and Gail in that there are some things that need to be done to the house. We hadn't quite set aside as much money because, well, certain things are more expensive in the world we live in right now. But also, I don't think we thought they were going to all hit us at once. And so, yes, I have some things that generate cash for me. That cash can normally be set aside, but this may overwhelm my cash stash, which leaves me thinking, am I going to finance, which I might do, but I understand why you wouldn't want to. I just think that that's an option to keep in mind. Even if you don't like it, you might sit there and go, wait, if I'm not selling because I want to wait for things to come back, or I think that it's going to be a good time to get a bounce back in the market, well, maybe your return on your money will be better than what you're getting, than what you're paying. Probably not at this point, but it depends on how you're structuring any sort of a deal. And I haven't looked at car loans, which is your situation, Ted, but for me, it could be done in other ways, like a home equity line of credit or something along those lines. But if you're not going to borrow and you're going to have to raise cash, yes, you have to go through the selling decision. And yes, the answer could be any of the things that you talked about, right? I would be looking at the same thing. Obviously, there's an amount of money I need to come up with. Do you just say, what's roughly that amount of money? I'll just sell that one thing that fits that and boom, I'm done with it. Because that certainly is an easy way to do it. And easy's not bad, but it might not be tax efficient, right? If I'm taking it out of a taxable account, I have to consider capital gains. If it's something that has a loss or that I could take a loss with, I might match losses and gains to meet that amount. That way I don't have to really worry about capital gains. But that depends on what you've got in your portfolio. I am a long-term investor, so I don't have much in the way of losses to offset gains. In fact, if I have losses, I probably use them at some other point when I was rejiggering my portfolio. Could you tap into a Roth IRA? Well, I would tell you that I probably would not tap into a traditional IRA. And depending on where you are, if you're not tapping into retirement assets, you said we're of similar age, but you didn't say if you're working, etc. I wouldn't necessarily go beyond my required minimum distributions if I had an IRA that I needed to tap. If we're similar ages, you're not at the spot where you have RMDs yet, unless you've got an inherited IRA, in which case you might have RMDs. So I'd be looking at what are the circumstances, right? If you had required minimum distributions, well, then you might just take the RMDs and see if that gets you there and then decide what you can do after you're through that amount. If you have no RMDs, yeah, I'm not doing something to try to generate a tax bill if I don't have to. So yes, that might mean I would use a Roth IRA if I had no tax losses. But I also might look at the situation as an opportunity to rebalance, because you said something important, which is that you like the fixed income side of the portfolio, you like the income it's generating, and you don't think you have enough of it. Well, then you don't really want to pull from it, because that's going to leave you a portfolio that's out of balance. And to get it back in balance, you're going to have to sell more things. So what you might want to be doing is saying, what is the asset allocation I want and how far away from it am I? At that point, you might be selling things based on, this is what I need to do to get my portfolio to the balance point I want. In other words, if you've got to take out, let's just say it's $40,000 or $50,000, if removing that amount of money would leave you with a portfolio that were better balanced because you took it out of the equity portion, then I would be looking at potentially doing it that way. I'd still want to be tax efficient, right? If I had equities in a Roth IRA, I might pull the money from the Roth IRA rather than pulling it from a taxable account, because that way I'm not generating a tax bill. Or I would say, let's sell equities in which I have a loss, or equities where I can match a loss with other gains and reduce my equity portfolio that way. It's kind of rebalancing in reverse. Normally you sell your winners and invest in your losers, and you might be doing some of that here, but the most important thing is saying, let me get to the asset allocation I want. Because at that point, you're making not just a sale for the sake of let me get the money out, but you're also saying, let me rejigger the portfolio. And especially if you're looking to do more with fixed income, right? If you think you need to change your portfolio, you don't want to change it further away from what you want. You want to make it more towards what you want. So yes, as counterintuitive as it might be to say, wow, the market's been getting hammered, do you want to sell into it? This is that excuse to say, okay, I'm going to realize losses or downturns. I'm going to turn what has been a paper loss since the market peaked in February. It's regained what it lost after Liberation Day, but I'm going to take that and recognize that it's not going to be at the peak. That's okay. But I'm going to have a portfolio that better reflects my desires going forward and that has given me the cash I need to keep going. So your thought processes were right. Those are all the things you have to look at. To me, the first thing is, if I'm being forced to make a move to get money out, I want to be looking at how do I do that as efficiently as possible. And efficiency comes on two fronts. There's the tax front and there is the portfolio construction front. I do not want to say I made a move that was tax efficient, but I dislike the way my portfolio is set up. Now I've got to make another move, because it would still be tax efficient, to get my portfolio right. Ultimately, you want a portfolio that you can live with as you move through whatever we're going to be seeing next. So use this as an opportunity to say, what have I lost faith in? What can I move? Remember, too, that if you need to rejigger your portfolio, if you've got, and you didn't say how your assets are distributed, if the bulk of your assets is in retirement plans, you can reallocate there without paying capital gains, because you can move things around in the retirement plan and you're not facing any sort of situation. So again, take a look at your specific circumstances. I can't tell you, Ted, because you didn't show me a portfolio and I don't know what your cost basis is and all the rest. But also, if we looked at your situation and you compared it to my situation and every other audience member, the right move to make is going to be very personalized here. It is going to be, you have more in a Roth IRA, they have very little in in a Roth, they have it all in other accounts and they don't want to trigger tax moves in their 401k. So they're looking at whatever taxable money. Somebody else may have zero taxable money. Everything's in a Roth or in a 401k. So how you are set up will have a lot to do with it. Minimize the taxes if you can, but come out of this with the portfolio that you want. Because otherwise you're just going to have to make another move. Like if this is not a thing you want to do, what I can tell you is I won't be selling stuff that I really want to own. I will get rid of the things that I go, this is what I have the least faith in and what I need to move. Because if I'm going to pay a tax on getting rid of something like that, if I don't have losses to offset gains or what have you, I want to get rid of the things that I don't have faith in that will get me to where I need to be. And yeah, you could match things up and say, let me sell this because it's the right amount. But that's not where you start. Start where you're going to get to the portfolio you want. You're going to get out the money you need, and you're going to do it without paying more in taxes than you would need to. Use this to your advantage, Ted. I appreciate your writing us. Thank you so much for doing it. And for everybody else out there, Chuck at moneylifeshow.com. Got a question like this one? Yeah, got an idea? Did you think I got it right or wrong? Would you do it differently? Don't be shy about sharing with us. We'll share the opinion with everybody else too if there's something else out there that works. But things like this, these are questions that if I can't answer them for you, I will get someone who can.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Welcome to the big interview on the May 23rd edition of Money Life. Returning to the show today, Jack Janasiewicz. He is portfolio strategist at Natixis Investment Managers. im.natixis.com if you are looking for more information. He also, by the way, is Senior Vice President, Portfolio Strategist, Portfolio Manager. He does a little of everything because he's responsible for providing their insight and analysis on what's happening in global economic and capital markets. So we've got a few things to talk about. Jack Janasiewicz, welcome back to Money Life.
Yeah, great to be back, Chuck. Thanks for having me.
Let's start with your general picture of where we are now, because the markets have recovered, but that doesn't mean that things are settled. It's this very uneasy tension. So should it be an easier tension, like just kind of normal dynamic market tension, or we're literally all on pins and needles waiting for the next shoe to drop?
I think we like to frame this as one big range trade, and we're probably a lot closer to being at the top of that range rather than closer to the bottom. And if you sort of think about the S&P, where it's traded, and when we got down below that 5,000 level, it certainly, I think, at that point was at least pricing in a mild recession. You know, when we've gone back and looked at historical drawdowns for a mild recession, you get about a 20% correction from peak to trough with the S&P. And if you measure the most recent drawdown all the way to that 5,000 level, you were down about 20%. So at least there, you get an idea that we were pricing in a modest recession. Looking at where we are today, you know, we're basically almost back or above where we were, pre-Liberation Day, if you will. So, you know, we've clawed quite a bit of that back, but I still think there's some headwinds that are potentially looming out there, and that might limit the upside. One being the move that we're seeing in the bond market, but we also are seeing, I think, the economy slowing, especially on the labor market side, and that still might take a little bit more time to work its way through into the real data. And I think once we do start to see that marginal slowing, we might actually get a growth scare at that point. And that's why I think we might have a little bit of a capped upside from here going forward.
Define a growth scare. What does that actually mean to you, and what does that mean that we're about to live through?
Yeah, and that's also, I think, a very important point, because when we think about a growth scare, it really mixes the fundamentals with the sort of the sentiment of the marketplace. And, you know, we certainly will see some softer economic data coming through. And the risk is that the market interprets that as something that potentially could morph into something, I guess, more sinister, like an actual recession here. And so as those numbers slow, the market gets a little bit more concerned about that slowing growth, and then they start to de-risk because the market starts to think about the recession, how it's picking back up. We're a little bit hesitant, though, to really go into that full-blown recession mode, simply because at that point, you probably will start to see a more dovish tone from the Fed starting to permeate back into the marketplace. And that probably puts a floor under things in here, but enough where that growth scare could potentially, see a correction in asset prices. Again, something in the order of potentially, another 5 or 10% correction from current levels.
Where are you in terms of gold, which most people see as an inflation hedge, but it's been horribly ineffective as an inflation hedge? It's just been a good geopolitical hedge, so it's benefited. But is gold in the same range bound and it's near the top of its range, or can gold keep running because there's so much more demand right now?
I think it's probably got some more upside in here. When you think about not really just the sort of inflation hedge and maybe the dollar hedge concerns, but there's been outright purchases of gold. We have it, from a perspective of the Indians who like to buy it from a jewelry perspective. But I'm thinking, I think to the bigger picture level, you're looking at central banks that are trying to diversify away from the dollar, because we've seen the dollar being used as a financial weapon, so to speak. So, countries like Russia, like China, like Iran, we've seen them trying to diversify away from those dollar holdings so they're not really held to the financial constraints if we impose sanctions on dollar use from them. And so I think you have some diversification away from the dollar by global central banks. And that's really, I think, putting some of that upside pressure on the dollar. And that probably will persist for the interim here. So again, you probably see the dollar continuing to just sort of grind up in here over the next couple of quarters.
If the tariff policies are to work the way the president has suggested they will, we need the dollar to be significantly weaker than it is. I don't think most people are prepared to go through what that entails. But do you take a look at the dollar and say, given where it's at, that's one more reason to be investing internationally right now?
Yeah, that's a tricky one. And being dollar investors like we are here in the United States, when you start to look overseas, that additional component from the FX return really does matter. But, I think the move that we're seeing more recently in the U.S. dollar might just simply be a little bit of a correction. When you look at the trade-weighted dollar or even the real effective exchange rate, look at it and zoom out from a longer period. So you're looking out maybe 25 or 30 years, for example. The dollar is trading closer to that one of the most expensive bands that it's been at in quite some time. So seeing a little of that edge come off, that certainly makes some sense in here. And so I don't necessarily think that we sort of would expect to see a significant turn in the dollar so that we continue to see a constant depreciation in here. Because, when you think about where the dollar is used and you think about it from a global markets perspective, whether it be credit that's been issued globally or just the number of financial assets that are denominated in U.S. dollars, it still dwarfs every other currency out there. And so as a result of that, the dollar is still the backbone of global portfolio allocations, the backbone of the collateral chain, the backbone of the payment systems. I just have a hard time seeing it continue to depreciate going forward. So I think more of this is a short-term idiosyncratic issue rather than more of a long-term fundamental shift in here. So again, short-term, yeah, we could continue to see more dollar weakness, but I don't think it's a longer-term trend that we should be looking to try to capture in here.
Do you worry at all that some of the actions that we're seeing are changing the way foreign governments look at us? As was said on the show here recently, not by me, but by one of our guests, our number one export is our debt, and our debt was just downgraded, though it was by the third. It's been downgraded for 14 years now since the first time it happened, et cetera. Do you worry that any of that math is changing long term?
It's been changing certainly near term. When we start to look at some of the data that comes out from the Treasury and from the Fed, we've certainly seen a reallocation of some of the bigger holders, right? China's always certainly come up, and to a lesser extent, we've seen Japan sort of slipping back down a little bit, but we've also seen countries like the UK starting to pick back up again. More importantly, you've seen really the domestic forces really coming back into play, right? When you start to talk about the 10-year yield pushing north of 4.5%, there's some value in there, especially relative to the broader markets. and you start to see household, asset companies here in the United States actually starting to move back into those sort of fixed income investments here. So at the margin, we certainly have seen foreigners shifting a little bit, but they're just being replaced by the domestic buyer here. And, again, as yields move higher, there's a value there, and that's where you start to see buyers stepping back in. And I don't think that's about to change anytime soon. I think ultimately it comes down to, inflation and growth expectations. And at the margin, we might see a little bit of growth slowing and a little bit of an uptick in inflation. But are these, I think you need to see the extremes here. You need to have inflation probably pushing well north of, 3%, and you probably need to see an actual recession kicking in where I think you really may start to see that buyer base step away, and that's probably the biggest risk. But, that's just not how we're seeing the outcome here in the United States anytime soon.
Let's talk about the index because, the S&P 500 has been dominated by the Mag 7, et cetera. Right now, to you, is the more interesting investment story still the Mag 7, or is it the other 493?
Yeah, it's still, I think, going to be that Mag 7. I know they've re-rated quite a bit, which then makes them a little bit more interesting because they've sort of had the that multiple move back down to something that's probably closer to where they should be trading. But you're still looking at, names of or companies that produce things that we use on a daily basis. You're still looking at companies that have significantly higher margins than the broader market. No debt on the balance sheet. They're buying back stock, huge amounts of cash. You can almost make the case that the Mag 7 really operates, we call it chicken beta, 1 foot kind of in that defensive bucket because of those characteristics I just walked through. But you're also looking at, potential upside because the earnings backdrop still remains pretty robust. And so I have a hard time seeing the Mag 7 giving it up. We might see some subtle shifts under the surface. And at that point, maybe you just simply say, it's not just the Mag 7, but it's the Mag 7 in broader tech. And I think that's really the bigger story here. That's not going away anytime soon. Tech is going to continue to be the area of the market where growth will continue to persist. And you still want to have access and exposure to both the Mag 7 and the broader tech space.
Will we wind up eventually getting the small cap rally and the rest, or are we going to wind up seeing more of a mid cap rally? Because that's actually, we've seen such a reduction in large cap because the Mag 7 has been so dominant. We now have things like General Motors being a mid cap stock. Does that change the way we classically expect things to work?
So I think there are 3 components that we look for to really see the small cap trade kick in earnest. And I think a lot of people were looking for that last year. And I think 2 of the 3 components were there. And that was one of the reasons why we weren't quite as optimistic as I think maybe the general market was regarding small caps. But, you want to see a significant re-rating from a PE perspective. And we certainly have that right now. You also want to start to see the potential for rate cuts, right? Because a lot of these companies are certainly interest rate sensitive. And so the third component then falls into the idea of you need a reacceleration of growth. And I think last year the piece was missing was the reacceleration of growth, right? The Fed was cutting last year not because growth was slowing, it was largely because inflation was coming down. So you were missing that growth component. If we look at maybe the back half of this year, when we get that growth scare that we just talked about, you potentially could see, maybe from a technical perspective, we get that definition of a recession, but we still have maybe marginal positive earnings growth. But you certainly could see those 3 line items coming together, right? You've already had the PE multiple re-rating. You potentially could have a growth scare / modest recession. And then you've got the Fed stepping in and starting to ease rates. That's the cocktail that we tend to like to see when we start to think about adding small cap exposure. So maybe that's a back half of 2025 story, something we're certainly going to be paying attention to. Not yet, but we could see that maybe in the back half of this year.
The primary subject that seems to be on everybody's lips these days is what's happening with consumer confidence. How much can the soft data actually influence things here? I mean, consumers always talk about how miserable they feel about certain things and how prices are too high and the rest, but that doesn't ever show up in their spending. Now, we know that there are some numbers in the hard data that suggest maybe this time will be different, but those are the most dangerous words in investing. So how do you weigh the soft data here?
And that, I think, is the trick. And that's one of the key risks that we're thinking about going forward is that eventually that soft data, which has been pretty bad, eventually does seep into the broader economy. And you then start to see the hard data picking it up. But, you hit on the key point there. pay attention to what I'm doing, not what I'm saying. And, certainly we've heard, pretty dour numbers coming out of those consumer confidence numbers. But what's interesting, when we look at the flow data, for example, when we look at retail investors purchasing ETFs and long-only products, they've been buying consistently. I think over the last 8 or 9 weeks, we've had maybe 1 week of marginal selling. Other than that, it's been straight up net buying. And so again, and that confidence number certainly, it might feel bad and look bad, but people are still going out and putting money to work. Again, same thing. Retail sales have been holding up fairly well. We look at the credit card data on a weekly basis. Consumers are still spending. Maybe under the surface, those patterns are shifting a little bit. We've certainly seen a little bit of softening in, for example, the airline ticket purchases and hotel purchases. So, the vacation component, that's certainly softening up here. But you're just spending other money in other places in here. But that's the key going forward. It's going to be, will that soft data eventually seep into the hard data? And I think even one step further, it's all about the consumer. If the consumer starts to see job losses mounting, and then they start to pull back on spending, that's where you really start to see that growth slow down, accelerate. And that's one of the big picture key risks that we're looking at over the next couple of months in here.
How will you size that up? When you say you're looking at it, what will be for you the trigger that says, there's my sign? Consumers really mean it this time.
Yeah, I think there's a couple things that we would be paying attention to. That's real-time data that comes out on a weekly basis. The first one being jobless claims. It certainly feels like the market is getting softer. We're not seeing, at least on the hiring front, that's certainly slowed markedly. But when you look at things like job openings, those are slowing. So the good old beverage curve there, as openings continue to slow, you should ultimately start to see that move into the unemployment rate. So, you start to see the anecdotal evidence with jobless claims moving higher, and then you start to see the credit card data that we just talked about, starting to slow a little bit. It's really those real-time indicators of the consumer, and those are probably the two best indicators that we get from a real-time perspective: jobless claims and the credit card data. Those start to deteriorate, and that's probably going to be the trigger that says, okay, time to take a little bit of some chips off the table in here.
Do you think the Fed's cutting rates this year?
Good question. We're still in the camp that we probably get 2 cuts between now and the end of the year, but you're probably talking about sometime after that July meeting where those cuts start to kick in. So maybe the last 2 meetings of the year, we start to get those cuts, but we're still in the camp that we do get something before the end of the year from the Fed.
And what do you think will spur the Fed to move? In other words, which problem are they solving for? Is it going to be that inflation is lasting longer and staying stickier, or is it going to be that, given everything else that as it plays out, we're going to see a hike in unemployment?
Yeah, I certainly don't envy, Chair Powell's position right now, because if you look at a lot of the commentary that came from their last meeting, the balance of risks has certainly shifted, and they indicated that both those risks are working against them, right? The inflation remains sticky, and the potential for a softening job market still remains. But, I think as we move into the second half of the year here, that balance might shift a little bit more to the labor side of the mandate, because, once labor starts to get softer, there's a little bit of momentum, a little bit of inertia that gets involved in there, and that's a tough train to turn around. So I think the Fed's pretty cognizant of that. So once we start to see the actual labor data, and the argument there is maybe that's a smidge too late, but once you start to see that labor data softening up, that's when I think the balance of risks will shift a little bit away from that inflation backdrop and maybe a little bit more of a focus on the labor side of the mandate, and that'll give the Fed the green light to start to get a little bit hawkish. But keep in mind, Chuck, we're still, I would say, tight. With wage growth nominal wage growth slowing and a modest uptick in inflation, that's certainly not good for growth. So the risk is, I think, for growth to slow a little bit more in here. And again, from the Fed's mandate, that's I think another thing that's going to be building up. And the Fed is still running at a rate that's higher than nominal and real wage growth here. So that's restrictive. So they do have room to cut because they are modestly restrictive at current levels, we think.
Yeah, it's going to be interesting to see how it plays out. And speaking of how it all plays out, when we started, the very first answer you gave me was talking about how you believe the market is range-bound, a wide range, where we're closer to the highs than we are to the lows, and that's the market record high level versus the April low level, but we're sort of in that range. Do you believe that we can break out of that range without some measure of certainty on tariffs, without some resolution with what's going to happen in China. And I'm talking about either way. Like, is there anything that sends us through the floor? Because we wouldn't mind a little downside protection. It didn't feel good to get there, but a lot of people expected it to get a lot worse. Muddling along is not necessarily going to bother too many people. So is this a protective range, or is this a range that changes on a lot of headlines?
Well, the way I would describe what just happened, it's really the technical side versus the fundamental side, right? I think the fundamental side, as I mentioned before, sort of priced in that recession, and then everybody sort of de-risked. And then all of a sudden we started to come back, and the fundamentals got, I wouldn't say better, but maybe back to neutral, so to speak. We've had a little bit of walking back of the tariffs. So we're sort of back to where we were, April 1st, April 2nd. So, you can certainly say the fundamental story, at least at the margin, is not getting worse. So, the market does like to operate in that first and second derivative backdrop, so to speak. So at least it's not getting worse. And with the tariffs sort of being put on a 90-day hold, maybe at the margin you could argue gotten a little bit better. But I think that the technical side of the equation is that as that got better, the market had over-extrapolated that downside risk, and you had a lot of leverage players that had de-risked and degrossed, and now they're chasing the market higher in here. So a lot of the bounce to me has a lot to do with the technicals of the market being a little bit offside, back on sides a little bit more right now, and sort of move out of this range. You probably now need to get back to the fundamental story. And so the list you just ran through there, really that's the checklist for the fundamental story. I think greater clarity on tariff policy, I think would help. Again, a lot of this is just getting rid of the uncertainty. And sometimes maybe we would say, well, if you end up with a 10% universal tariff, that's not good. Well, at least you know the rules of the game. And I don't think 10% is really all that bad, because you're certainly going to have some companies passing those price increases along to the consumer, but some of that's going to also get eaten. And we're actually operating at almost close to record high profit margins. So there is room to share some of that burden around. And as a result, things I think could then sort of grind a little bit higher here on the fundamental side. So I think the key is the uncertainty cloud lifts and we just get certainty. And that changes a lot of dynamics in here from a fundamental perspective, because now you at least know the rules of the game. And I think that uncertainty is the big one. So the fundamental story needs to see uncertainty clean up.
One last question that gets us away from fundamentals and puts us in a place where realistically we don't want to have much of the conversation. Normally people want to make political events into market events, but it doesn't seem to really work out that way. But given what's been going on with the tariffs, but also with the extension of tax cuts, et cetera, does that become a market story in any way, shape, or form? Like if we see the extension of the tax cuts or we don't see the extension of the tax cuts, and I'm not asking to give you what you think is going to happen there. I'm just wondering, does any of that trickle into the market?
The key risk on that front really comes back down to what I would argue is does the market look through that reconciliation bill and think of it as, a significant increase to the fiscal deficit, and does that put upside pressure on rates? So would we see the 10-year potentially drifting up closer to 5%, that sort of backdrop? So, I think some of that does potentially have a key risk to the marketplace. And I think anytime you get rates close to 5%, there's going to be some indigestion in equities as a result of that. And so the risk really does come back to, does the market really see through some of that dynamic scoring that is potentially going to be really what that reconciliation bill relies on to get passed, and simply say, I'm not sure those numbers are really going to add up. And as a result, that deficit just widens out. And, oh, by the way, we have to finance that. And that just puts a little bit of a scare into the marketplace, and we see rates push higher. So I think that is how that political backdrop could ultimately work its way into the actual markets. And it really comes on the bond market side.
Jack, great stuff. Time has flown by, but we've come to the end of what we've got. Thanks for joining me. I really appreciate it. We'll talk to you again down the line in the not too distant future, I hope.
Always fun, Chuck. Thank you.
That's Jack Janasiewicz. He's Senior Vice President, Portfolio Strategist, and Portfolio Manager at Natixis Investment Managers Solutions. He runs their insight and analysis on global economic and capital markets themes. If you want to find that insight, go to im.natixis.com. You can learn about the firm and you can check out his insights there. And we'll be back to send you off to the Memorial Day holiday. We'll let you know what's up for next week with Money Life and more right after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
So it's another week already.
Yes, it is. And this is the week that gets us up to Memorial Day. Hard to believe we are this far into the year. It seems like just yesterday we were doing all the New Year's stuff. But Memorial Day is kind of not just the holiday for all the things you think it is the holiday when the lacrosse world takes over, because we have all the NCAA championships, which are here in Boston this week. So I'll be spending some of my time with that. We will not have a show on Monday, but when we come back on Tuesday, John Petrides from Tocqueville, plus my friend Sarah Bongiorni. She wrote a book back in 2007 called A Year Without Made in China that I loved. It has the distinction of being the only book I've ever written a blurb for, specifically. There's a reason for that in my career why I wasn't really allowed to write blurbs, but Sarah being a friend of mine and the book not being about investing, I was allowed to do it. Loved the book then, still love it, and maybe love it more today, which is saying something, but it's because of all the stuff we've got on China. And she's going to talk about just the challenge she had and what that means in terms of, well, now you've got all this stuff with tariffs and how it could impact people, and what she's going to tell you about just the practicality. And that was, again, years ago. So it's not like this situation was eased up on and that it would be easier to do what she did today. It should be a very fun conversation. I'm looking forward to it very much. But also coming next week, Lawrence Kotlikoff is coming back to the show. We should get that interview that we were supposed to do with Jordan Rizzuto from Gamma Road. We did the interview, but we held it because their indicator changed. He's coming back on the show, and much, much more. So plan to be here after you enjoy Memorial Day. Meanwhile, if you're looking for something to celebrate, today is National Lucky Penny Day. It is National Road Trip Day.
Road trip! Woo!
While you're on the road trip, turn on some music and appreciate the title track, because it is National Title Track Appreciation Day. While you're on the road trip, bring along your sunscreen, because it's National Don't Fry Day, and don't frying is about sun, not about fried foods. And then on the food front, it is National Taffy Day. And then it's not really about food distinctly, but National Cooler Day. So you can put anything you want in the cooler, so then you can celebrate all your food and what have you. I, of course, will spend the weekend not only doing the lacrosse stuff, but I will be dealing with the flooding here in the house that I mentioned at the beginning of the show. I hope it is not that bad. But in honor of the flood, I will just tell you that the coup de grace on today's show, the very last sounder that we do all the way at the end, it comes from the 10 Commandments. Just flooding was part of that, the parting of the Red Sea, etc. It just kind of feels like the water's all here on us today. So that's where I went with that. Where I went with my guests, well, Brian Griggs is head of portfolio strategy and solutions at Nuveen. It's nuveen.com. And then Jack Janasiewicz is portfolio strategist for Natixis Investment Managers Solutions, im.natixis.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Warren Buffett, who said, "There are people that make you want to be better than you are, and you want to hang out with people that are better than you are and that you feel are better than you." Well, our service members and the folks we remember on Memorial Day weekend, they are a cut above, and they have done something that the rest of us, most of us have not done, cannot imagine doing, etc. So appreciate them, and remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great Memorial Day weekend, everybody. Be safe, be calm. We'll see you here again on Money Life on Tuesday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
So let it be written. So let it be done.